So in chapter 14, we spoke about the history of essentially money in the European area, and we talked about um, how money played a role, say, several hundred years ago, all the way to European monetary system, establishment of European monetary system, followed by adoption of euro in January 1st, 1999. Chapter 15, we delved a lot deeper into what makes an optimum currency area. We looked at the political and economic factors that are desired in an optimum currency area. We asked whether European Union is an optimum currency area. Now we're going to dig a lot deeper into the European monetary system. However, for chapters 13, 14, and 15, what I did was I would handwrite the notes, and then after handwriting the notes on OneNote, I would superimpose, I guess, the audio component of it. I think it's probably easier and better for you guys if I just follow along with the notes that I have typed up and that you see on Blackboard, because it'll allow me to really pay attention to the notes, and the various nuances of the chapter. But more importantly, it also allows me to include more live data, which you will see in parts that follow. I've included a few graphs, so I'm able to discuss those graphs in detail, and they're live graphs with you guys. So I'm hoping this would be a different experience than what we've done in the past. So without further ado, let's go ahead and start with the discussion on European monetary system. So as we learned towards the end of chapter 15, when we talked about Maastricht Treaty, or end of chapter 14 when we talked about Maastricht Treaty, basically EMS was designed to keep exchange rates stable, and it was formed as a result of a deal between Germany, which agreed to abandon its strong currency, if you remember, in exchange for sort of unity with East Germany, so merger of East and West Germany, and the deal between Germany with other countries who wanted to move away from the unstable European monetary system, but they still wanted the exchange rates to be stable. So remember, they wanted to move away from European monetary system because they didn't like that Bundesbank was the de facto monetary policy maker of the European Union, and they said if Bundesbank is going to be a de facto monetary policy maker, then they would want a say in it, and might as well sort of have a centralized system in which they make monetary policy. So that gave birth to not European Monetary Union system, but European Monetary Union. So I will fix this. So as a part of Germans' agreement to form a single currency, they requested some guarantees, because they worried that the new currency will not be as strong as its own currency. So they wanted some guarantees, and these guarantees are based on certain principles. Okay, so the first principle is the principle of price stability. So what is price stability? The euro system, which is going to be the term we use to indicate to identify members of the European Union, the European Monetary Union. But the euro system has chosen to interpret price stability as essentially an annual increase in price below 2%, right? So there's no hard and fast directive on it being 2%, but the market interprets it as 2%. So the technical language in the Maastricht Treaty and in the formation of the European Monetary Union says, or reads, The primary objective of ESCB shall be to maintain price stability. Without prejudice to that objective, it shall support the general economic policies in the Union in order to contribute to the achievement of the latter's objective. Okay, so that's the official language. As you can see, it doesn't talk about any specific percentages, but it does talk about, but it is interpreted as approximately 2%. So what's the why do we need price stability? And we have discussed this in the chapters before starting this chapter. The logic behind price stability has to do with the monetary neutrality principle. And if you remember, monetary neutrality principle basically says in the medium run, monetary policy can affect economic growth and unemployment. But in the long run, monetary policy only impacts inflation. So the European Monetary Union or the Eurosystem realized that part of the challenge they had faced over the last pretty much 100 years upon adopting paper currency is every country tried to quote unquote outsmart the other country by using monetary policy to make their exports cheaper and imports expensive, and in doing so in the short run boost their economy. So they wanted to get away from that, and price stability became their main objective. But as I said a second ago, monetary policy affects economic growth and unemployment. And so in the short run, if you're really smart at how you use it, it can help with ensuring full employment. And so full employment then becomes the secondary objective. Now, this is different than US's Federal Reserve's objectives. Remember, US's Federal Reserve, or US's central bank, known as the Federal Reserve, has a dual mandate, and the dual mandate is price stability and full employment. So keep in mind the subtle difference here is that in the US, they give equal weight to price stability and full employment. In Europe, in the European monetary system, or in the European Monetary Union, full employment plays a second is a second fiddle to low inflation or price stability. Okay. The second principle Germans wanted was central bank independence. So I know this is a no-brainer, especially in the late 1990s, because of course people want price stability and therefore they want central bank to be independent. But many times what happens is there are various elements that benefit from price instability, and they would push the central bank to sort of quote unquote assist them. For example, if you're a financially stressed government, then you may see that might as well print as much money as you can, because that's the least bad option as opposed to taxing people. So you print money to make your own money and then use that to spend in the local economy as opposed to taxing people. So those governments may end up using their printing presses excessively, which in turn makes the price unstable. Okay. The second group of people that would benefit from price instability are exporting firms whose competitiveness depend on exchange rate, right? And therefore, they may like a relaxed monetary policy. Why is that the case? Think about it. If the monetary policy was relaxed in the sense that interest rates were too low for too long, it would cause inflation locally and prices would rise. If prices rise, then the export prices rise as well, right? So put differently, let's say if interest rates are too low for too long right now, we are in the middle of coronavirus, interest rates are pretty much at 0% in the US, and let's say unnecessarily the central bank continues to maintain 0% interest rates for a pretty long time. In doing so, what will happen, say in 2 or 3 or 4 years, prices will increase because of inflation. Everybody's going to expect a higher salary, right? Because older salaries are no longer applicable. Or because people expect higher salaries, cost of manufacturing and cost of services would increase. And because cost of services would increase, prices across the board would increase. So if you're an exporter, this would benefit you, right? If you make iPhones and you want to sell it outside of US, higher prices will benefit you. Okay. A third group of people that would benefit from unstable prices, and so just to clarify, these none of these players are necessarily beneficiaries of unstable prices, but they're beneficiaries of economic events that cause unstable prices. Okay, so trade unions that are concerned with unemployment also like relaxed monetary policy, because lower the interest rate, higher the investment, higher the jobs. So trade unions also like relaxed monetary policy. Debtors are an interesting group of people that like price instability, because in some ways it raises the value of their liabilities. So in other words, if inflation is high, it raises the value of their of what they owe. Let me give you an example. If I buy a house for $1 million, for example, in the Washington D.C. area, and the interest rate that I get, which I'm pretty sure I can today, on a 15-year loan, is about 2.5%. Let's just say. Well, lo and behold, 2, 3, 4 years from now, inflation increases, price level increase by 3 or 4%. Well, in the grand scheme of things, I'm actually getting paid to maintain that loan, because my interest expense is only about 2.5%, but the inflation price, the rate at which prices everywhere else increase, is 3%. So in effect, the bank is getting lesser money in real terms than it would had it not lent me the money and waited for inflation to increase at 3% and lent it then. So that's how debtors like high inflation, because it raises the value of their liabilities. Banks also like, banks like policies that cause high inflation, which is low interest rate, because with low interest rate, the only way to accomplish the goal of getting low interest rate is to flood the market with liquidity. So the Federal Reserve would essentially print cash and buy bonds and flood the market with liquidity. And banks like when liquidity is plentiful. Okay. So these are the groups of people that would try and influence central bank. But this is exactly why one of the principles Germany wanted was independence of central bank. Okay. The third component is fiscal discipline. So monetary policy can be undermined by government borrowing from the financial markets, and one of the challenges with that is the governments can just keep borrowing money from the financial markets if it didn't have to face any consequence. Specifically, if they're a part of the monetary union and the consequences are shared, but the benefits are not shared, in that the benefits go to the country that borrows. So if deficits are large enough, towards the end, the government global financial markets may not want to lend to that specific government, which would then cause exchange rates to crash, right? And that was something we saw during the financial crisis, when the Greek government tried to borrow money. At the heart of the financial crisis, you could get 30% interest rates because nobody wanted to lend them money, and people feared that they would leave the European Union, which, of course, if they left the European Union, and as I mentioned a second ago, if their exchange rates would therefore to crash, then in real terms, you're not earning any money, right? So fiscal discipline was important for the Germans. So the pressure on the central bank to create money and finance the deficit, it was very high, right? And this in turn causes inflation in the long run. So remember, our first point was price stability, and fiscal discipline, indiscipline, in the grand scheme of things, just causes inflation. And furthermore, one last point about fiscal discipline is that in the monetary union, this threat is only compounded by the fact that political ideology changes from, specifically in the monetary union, from spend now and tax after election to spend now and let the central bank pay for it, right? Like if you're an Italian politician and if you're worried about getting reelected, the best way to get reelected is to give a lot of freebies to a lot of your constituents. Well, in a monetary union, this can be a problem because what you're also saying is, why do I care about my debt levels? Because I have a common central bank with the rest of Europe, and so let them worry about my debt levels, right? Because it's not like I have to pay back. I mean, it'd be if they don't come rescue me, basically their exchange rate would plummet, right? And that's what politicians would argue when they induce all kinds of spending. So those are the three principles. And based on these principles, they created what's called the five entry conditions of the Maastricht Treaty. These are the conditions to get admission into the Eurozone. Now, if you notice, once we're done with this section, you'll see that not a lot of these conditions overlap with the optimum currency area criteria that we discussed in the previous chapter. So the idea is a lot of these entry conditions are conditions that the country should have already demonstrated that they have met before they're able to apply for and join the Eurozone. Okay. So these are pretty, in some ways, dry conditions. So we'll just zoom through it. Inflation. So to be eligible for membership, a country's inflation should not exceed more than 1.5 percentage points above the three lowest inflation levels achieved by EU member states. So the idea is you rank inflation levels in European countries, and you go for the and then you average out the three lowest inflation countries, and any country's inflation who desires to join the Eurozone cannot exceed more than 1.5 percentage points above the average of those three countries. Okay. So what happened, right? And what happened was the Mediterranean countries, which would be Spain, Ireland, Portugal, were able to bring down the inflation to the acceptable limit by 1998, but Greece failed. Greece was not able to bring down inflation to the level prescribed. Okay. So I have a chart for inflation, and to see how various countries did right before adopting the euro. So this is actually a good chart. So as you could see here, on the left axis, you have change in growth rate from previous period. So this is growth rate in the price index. In other words, this is essentially annual inflation rate. Now this looks pretty noisy, and because there's all these countries. Remember, this is our marker. Our marker is 1999, when the countries joined European Union. Look at what happened to Greece's inflation. Greece's inflation, which was actually negative, went up slightly, and then it declined even more because they were taking measures to bring inflation back in check so that they can meet the criteria and join the European Union. And you look at all the other countries too. It appears that there is an urge to stay pretty much within this band to meet the criteria, the inflation criteria in the European Union. So that's an interesting find. One of the things you would also see is right before the financial crisis. I know I'm going off topic, but look at this. There's a convergence of inflation rate among these 6 or 7 countries that adopted the euro as a single currency, right? And in fact, that pretty much started happening even before the financial crisis, right after adoption of euro, right? So after the financial crisis, which is also known as the Great Period of Moderation, inflation began to increase. Okay, so I'm gonna clean this up. The second bullet point, which was long-run nominal interest rate. So an inflation-prone country can squeeze prices temporarily, at least definitely last year before admission, only to relax the efforts after entry. What they're saying is that the Germans realize that one of the that you could have inflation targets, but countries can artificially meet those inflation targets by just behaving for 1 year before the deadline, and then enter the European Union, and then going forward, they're not able to meet the inflation targets. So they also added a second target to it, which is the long run nominal interest rate. And so to weed out the cheaters, this criteria requires that long run interest rate should not exceed by more than 2% of average rates observed by three lowest inflation countries. So here's how it would work, right? If you were told that your inflation target is it cannot be more than 1.5% of the average of three lowest inflation countries, well, you would do is you would increase your interest rates to a point where it brings to an extent economic activity down to a standstill, which in turn causes a drop in inflation, right? Because if interest rates are too high, nobody's investing, nobody's buying those, borrowing money to buy those houses, buy those cars. This brings the economy down to a standstill, and sellers of cars and sellers of homes are forced to lower their prices, which in turn decreases inflation. So to avoid cheaters from cheating, this criteria required that long-term interest rate should not exceed more than 2% percentage points of average rates observed by the three lowest inflation countries. And of course, the reasoning is that the long-term interest rate mostly reflects markets' assessment of long-term inflation. So this is the key. Why not short-term interest rates? Well, overnight interest rates, as we all know, in the U.S., they're called the federal funds rate. Overnight interest rates are very tightly controlled by the central bank, right? But long-term interest rates are not controlled by the central bank. In fact, this is a perfect time to look for evidence on that. If you look at the cost of a 30-year mortgage today in the United States, today is what, April 11th, 2020, you'll see that, and then if you impose federal funds rate on the same graph, you will see that in the last month or so, the federal funds rate has decreased from 1.25% to 0%, but there's no parallel decline in 30-year mortgage rates. So long-term interest rates reflect investors' concern that there may be future inflation. So that's why they stuck to long-term interest rates as their criteria. The third criteria was ERM membership. So the logic behind ERM membership requirement is that the countries, and ERM, as I mentioned before, is the European rate mechanism. We have discussed this in previous chapters. But what they're saying is that you need to be a member of European rate mechanism, exchange rate mechanism, because you must have demonstrated that you have the ability to keep your exchange rate tied to the currencies of member countries who are now going to be your monetary union partner. So just to clarify, ERM membership in some ways shows that you have the discipline to do whatever it takes to maintain a lock with your future peers in the European Union that have also adopted the euro. Okay, and of course the requirement is that every country must have taken part in ERM for at least 2 years without having to devalue its currency. So the idea is, if you have the discipline to do whatever it takes to anchor your currency to somebody else's currency, as evidenced by your participation in ERM, then you'd be a good candidate to participate in in euro. I also think that this is sort of a smart way of getting rid of many Eastern European countries who were not a part of ERM. Because remember, euro was adopted in 1999, and Eastern European countries became a part of the European Union only in 2005. So this was sort of a way to bypass, sort of a nice way to say no to those people. The fourth criteria was budget deficit. So Germans are super disciplined as far as their budgets are concerned. In fact, it is my understanding that Germany, by their constitution, is not allowed to have an unbalanced budget, except in a very unusual circumstance, very strict guidelines. Unlike the American budget, which since Obama's presidency has only seen a deficit, right? In fact, we 2 years ago we passed the Tax Cut and Jobs Act, which cost us $1 trillion. Now we have the coronavirus crisis, and we've already spent more than $5 to $6 trillion on that. So every year, U.S. has a budget deficit, but Germans don't necessarily like that because they understand that its impact, the impact of fiscal indiscipline on monetary policy, which is the fourth convergence criteria, and it sets a limit on acceptable budget deficit of 3% of GDP. Okay, as I mentioned before, Germany had long operated on golden rule, which specifies that budget deficits are only acceptable if they correspond to public investment spending, because public investments is a source of growth which eventually generates resources needed to pay the initial monies borrowed, right? So that was the Germany's school of thought, and they wanted to impose that on everybody else. Finally, the other brother of budget deficit is public debt, right? Public debt is essentially sum total of all years' budget deficit. So just like inflation that can be lowered temporarily, deficits can also be made to look good in any given year. The point being, you just don't spend too much money as a government, and voila, you have a decent budget surplus. But the fifth criterion mandates a maximum level of public debt, which should be at 60% of the GDP, because 60% of GDP is very compatible with a budget deficit of 3%. In other words, what they learned is you can't expect people to have 3% of budget deficit on the one hand, but then on the other hand have like 20% public debt. It's just not compatible, right? It's just not going to happen. So there's a debt limit of 60% of GDP. But Belgium's debt to GDP was 120%. And in 1991, Belgium overhauled its finances and was committed to adhering to strict budgetary discipline. And as a result, Germany was a little bit more flexible in tweaking their rules, and they said, well, if you have debt level of more than 60%, but you are going in a direction where your debt level is going to decline, then we're gonna allow you to enroll into the European Union. So Germany showed some flexibility for Belgium. Okay. So that's 16.2. Section 16.3 is about the euro system. Part of the reason I'm omitting it is because it talks about how, like, literally the physical process with which monetary policies are made within the European Monetary Union, and it talks about the institutions and stuff like that, and how votes are take place, and so on and so forth. I think it's beyond the scope of this subject, in the sense that ours is more theoretical, policy-based subjects, and not necessarily the civic-based subject. So I'm omitting 16.3. Section 16.4 talks about the monetary policy strategy, and this is a pretty standard strategy that all big central banks of democratic societies follow. Okay, So we saw from the ISMP IRP framework that interest rates are basically decided based on the monetary policy schedule or the upward sloping monetary policy curve. And why is it upward sloping? Because as we discussed then, we said monetary policy schedule shows that the central bank increases interest rates when the economy booms, and it lowers the interest rates when the economy slows down. So this is counter cyclical, right? Federal Reserve's or central bank's responses to the economic situation is countercyclical, partially because it wants to keep prices in check. And so if economy is in a boom, if you don't do anything about it, then most likely prices are going to rise. Okay. So this strategy relies on three main elements: price stability and two pillars used to identify risks to price stability, right? So the first pillar is the economic analysis. This consists of a broad review of current and future likely economic conditions. So they look at growth, employment, prices, exchange rates, and trade conditions, specifically with foreign countries and large trading partners. This is very similar to the dashboard that Bloomberg maintains. It talks about what are, of course, these are all top secret criterias, but what the dashboard talks about is the criteria most likely used by American central bank, which would be the Federal Reserve, to make policy decisions specifically on interest rates. The second pillar is the monetary analysis, and it studies evolution of various aggregates. M3 is one aggregate in particular. So I know this sounds super convoluted, but basically the second pillar says the central bank literally counts how much cash is floating around in the economy, because historical research has said that in the medium and long run, the cash in the economy moves in proportion to inflation, and this in turn is in line with the monetary neutrality principle. So if people are saving too much, you won't see too much cash in the economy. If people are buying a ton of things, you'll see a lot of cash moving in and moving out. So given that monetary policy first affects growth and employment with a lag of at least 1 year, and then inflation with a lag of 1 or 2 years, central bank must anticipate the evolution of inflation over a 3 or 4 year period and make policy decisions accordingly. Because remember, monetary neutrality principle says in the short run you can massage the economy with monetary policy, but in the long run it will show up as higher prices. And the point I just made attests to that. Okay, so this monetary policy is nothing out of the blue. This is something that all central banks, especially the Federal Reserve, which would be the direct counterpart of the European Central Bank, follows. Okay, so let's go back to discussion on independence and accountability. So if you notice, now we are talking about going from philosophical components of European Central Bank to the inner workings of European Central Bank. So how does Europe ensure that its central bank is independent and accountable? Okay, specifically, one of the things to think about is what are the characteristics that are specifically crafted to ensure that the central bank is independent and accountable. So the first one is institutional arrangements, right? And what does that mean? It means that the Maastricht Treaty specifically requires that European central banks and all national central banks are protected from political influence, right? And how do they do that? Well, like most other components of joining the European Union, before joining Eurozone, each country must adapt the statutes of its national central bank to match a number of common legal requirements set forth by the European Union. Okay, so basically, change your laws to in its entirety to match what we want your laws to be, so that central bank independence is ensured. The second point is the status of Eurosystem officials. So, executive board members in the European Union are appointed for a non renewable period of 8 years to lessen the opportunity to pressurize them while they are in office. This is interesting because the Federal Reserve appoints, Federal Reserve Chairman is appointed for a 4-year term that can be renewed infinitely. So this is a little bit different in the Eurozone. And to be honest with you, all government is in some way affected by this. And I like the Eurozone, European Central Bank's rules, where you can only appoint the executive board for 8 years, non-renewable term. All politics should be like this, because then people don't make policies that would get them reelected, but instead they would make policies that truly benefit the people, because there's no incentive to do otherwise, since you cannot get reelected. National central bank governors are required to be appointed for a minimum of 5 years, right? This is, once again, if you want to be a part of the European Central Bank, then you need to incorporate this as a law of your country. No central bank official can be removed from the office unless he or she becomes incapacitated or is found guilty of serious misconduct, right? This is, once again, standard with the US Federal Reserve as well. And that has come in extremely handy with the executive branch as it is right now in the United States in 2020, where people are hired and fired at the whims of the president. I'm glad that the Federal Reserve is protected in that sense. So what are some of the policy objectives and instruments that the central bank is allowed to use? Well, the interesting part, and of course, maybe more obvious part, is that the treaty sets objectives in vague terms, because the idea is you want to not tie the central bank's hands in how it should respond to a crisis, because crises evolve, and so responses should evolve as well. But on the other hand, you also don't want people to be able to predict how the central bank will respond to a crisis. Because as we have seen in the past, there's money to be made by having beforehand knowledge of how a central bank responds. Okay, so the objectives are set in a very vague set of sort of way. But what's important is they don't really care how you respond to crisis, as long as price stability is your primary objective. And as I mentioned before, Eurosystem is free to decide on which instrument it wants to use. Fourth criteria is financial independence. So European Central Bank is financially independent because it has its own budget that is independent from the European Union budget. This is identical to the US, where the Federal Reserve is not taxpayer funded. So a lot of times when you work in an agency that's taxpayer funded, you take the stance of the executive branch that appoints you, right? So if you're a Republican, then EPA or Environmental Protection Agency takes a backseat. But if you're a Democrat, then EPA becomes a lot more aggressive. So similarly, Consumer Financial Protection Bureau takes a backseat when there's a Republican president, but is very aggressive in protecting the consumers when there's a Democratic president. So, Federal Reserve is not taxpayer funded, and it allows the leaders of the central bank to focus on meeting its mandate of price stability in Europe. Okay. Finally, or there's a couple more. Accountability. So here's where it gets interesting. Because the central bank officials are elected by the politicians that are in turn elected by the people of individual countries. So in other words, you can't elect a European Central Bank president. That election happens by politicians who represent their respective countries in the European Parliament. So because that's not truly considered democratic, there has to be a way to hold European Central Bank democratically accountable. And so one way that is done is the statutes require an annual report to be sent to the European Parliament as well as the Council of the Commission, which is essentially their government, European government, by the European Central Bank. Furthermore, the president of the European Central Bank is also required to do quarterly testimonies in front of the European Parliament Committee, very similar to the Federal Reserve. The Federal Reserve Chair, approximately each quarter, presents its report to the Congress, right? And so very similar to the European Central Bank. Finally, transparency. So again, very identical to the Federal Reserve. European Central Bank is required to show or reveal the contents of its deliberation, in essence, by saying, by sharing the thought process behind their monetary policy decision making. And the European Central Bank holds a press conference, just like the Federal Reserve, immediately after every policy setting meeting to present its decision in standardized terms. Now, this is normally, this is in the spirit of the US's Federal Reserve, but remember, at some point before Ben Bernanke, who was the chairman of the Federal Reserve 2 chairmen ago, so right now, so the last chairman was Chairwoman Yellen, and then it was Ben Bernanke, and before that it was Alan Greenspan. When Alan Greenspan was the chairman of the Federal Reserve, he pretty much told the press that if you think you can understand me, then I'm not speaking. Then I'm speaking too clearly, is essentially what he said, because he was known to speak in these convoluted terms that made it impossible to understand what he was trying to say. Okay. So that's those are the criteria with which ECB independence and accountability is ensured. Now let's talk about European central banks' instruments that they can use in response to any sort of crisis. This as well ends up becoming a little bit more generic because most central banks do this. So you may already know most of this. So like most central banks, European Central Bank also uses short-term interest rate as an instrument of choice because it has monopoly over supply of cash. As you may have heard, the Fed can print cash and as much cash as it wants. So of course, it's more able to control short-term interest rates. Why is that the case, right? And not only with the Fed, but also with the ECB. Well, because if you think about it, loans of 24 hours or less are as good as cash, right? Loans of 24 hours or less are as good as cash. So the central banks can control the very, very short-term interest rate, which is, as I mentioned, 24 hours or less, with a very high degree of precision. Now, why do they care about controlling short-term interest rate? Well, the logic follows that short-term interest rates or changes in short-term interest rates are known to have an impact on long-term interest rates and therefore the cost of credit. And because they all have impact on long-term interest rates, they also have impact on asset prices. Okay, they also have impact on asset prices, and through asset prices and through interest rates, they also have impact on exchange rates. And we have talked about this before in chapter 13, how exchange rates and interest rates, I guess, play with one another, right? However, the problem is these effects are not very precise, and they really depend on what people think long-term inflation is going to be and what the future policy actions are going to be. Now, this, as I mentioned a few minutes ago, goes hand in hand with if you want to look at do some of your own research and look at a real life example. Look at what has happened to 30-year mortgage rates over the last 6 months. Once again, we are in April. Look at from say January 2020 to April 2020, and you'll see that even though the federal funds rate, which are the short-term interest rates that are controlled by the Federal Reserve in the U.S., have dropped to nearly 0% from 1.25%. So essentially a decline of 1.25 percentage points. Yet 30-year mortgage rates have remained virtually unchanged from January through April. So you'll see that yes, the Fed can control, or the central bank can control short-term interest rates, but they're not in a position to control long-term interest rates, because the long-term interest rates are purely dependent on everybody's or the consensus expectation of future inflation. Okay, so I just used the term federal funds rate. What do Europeans call it in the Euro system? It's called the EONIA, which is the European Overnight Index Average, which is a weighted average of overnight lending transactions in the Eurozone's interbank market. What are interbank markets? Interbank markets in the US are usually made up of 15 or 20 largest banks in the world. So it'd be the same in the European Union as well. So EONIA is controlled in two ways, right? And once again, this is exactly identical to how you would control the federal funds rate in the US. So the Euro system creates a ceiling and a floor for EONIA by maintaining open lending and deposit facilities at pre-announced interest rates, right? So how does that work? Well, the marginal lending facility always allows the banks to borrow from the European Central Bank at a corresponding rate, which generally is lower than the ceiling. So this is borrowing. So this is the borrowing rate. It generally makes it a ceiling, right? The borrowing rate is a ceiling. Now, on the other hand, since the banks can always deposit cash at ECB's deposit rate, this becomes the floor. So this is how it keeps the rates in check. Now, it may be easier for me to talk about it from US's terms because I'm a little bit more familiar with it. But think about it this way. Let's say you're a bank in the US, right? And you can face two scenarios. One is you can borrow from the Federal Reserve because let's say, you want the money to lend it out to a home buyer, but you can sit there and wait for cash or deposits to come in, but that may take too long and the borrower may go to some other bank. So let's say if someone knocks on your door and says, hey, I want to buy a home, I need $1 million. And the bank is like, well, I don't really have $1 million. Let me see if I can borrow from the Federal Reserve at the federal funds rate on an overnight basis. So the Federal Reserve lends them the money on an overnight basis, $1 million, right? So that's the specified interest rate. The other scenario is a bank that is too much cash, right? It is too much cash. It does not have borrowers that want that $1 million. So what they can do is they can always go to the Federal Reserve and deposit the money at their Federal Reserve account for a specified interest rate. So clearly this interest rate has to be lower than the federal funds rate. Why? Well, if it is higher than the federal funds rate, you can always borrow money from the Federal Reserve at the federal funds rate and deposit it with the Federal Reserve at a higher rate. And then in doing so, there's an arbitrage opportunity and you'd make money, right? So by definition, deposit rates are lower than lending rates. And this is true with your and my bank account as well. Clearly, if you wanted to borrow money to buy a house, your interest rate is going to be way higher than your interest rate is on, say, a CD, right? Okay. So the Euro system conducts weekly auctions at a rate it chooses, right? These auctions are the means by which European Central Bank provides liquidity into the banking system. Once again, super identical to the Federal Reserve. It is my understanding that the Federal Reserve also does, I want to say, weekly auctions on I want to say Thursdays. I may be wrong, but exactly at 10:30 a.m. it auctions out um, uh, various transactions to maintain a certain level of federal funds rate. Okay. Now the question is, how does this liquidity flow from the euro system to eurozone? So to give you an example, let's say it wants to provide money to the euro system, the European Central Bank. Well, each national central bank collects bids from commercial banks and passes the info to the European Central Bank. European Central Bank, on the other hand, decides which bid it'll accept, and it instructs the national central banks accordingly. Finally, the commercial banks get liquidity from national central banks, and it distributes this liquidity on the interbank market. So once again, this sounds a little bit too technical, so let's add in some nuance, right? Let's say European Central Bank decides we need to give out more liquidity into the economy. And so it can do so by buying bonds, right? So when it buys something, you have to give people money in return. So it can buy bonds from its interbank partners, sometimes also known as primary dealers, and it can buy bonds from primary dealers, right? And the way it would do that is it would ask the primary dealer, how much are you willing to sell the bond to me under the agreement that you'll have to buy it back from me for a certain price tomorrow? So you tell me how much you want to sell it to me for and how much you're going to buy it back from me. And the difference is considered interest, right? The difference for one night is considered interest. For example, it can do that. The central bank can do that, and it can identify which bids it wants to accept. So this keeps banks in check in the sense that they now have an incentive not to ask for ridiculous valuations, right? Because theoretically, if I was a bank who was given this offer, I would say, yeah, I want to sell it to you for the highest price possible and buy it back to you for the lowest price possible. And the only thing that's stopping me from doing that is that there's a competing bank who is going to say, wait a second, I'm willing to accept a lower margin. Okay? So now that we have talked about different components and principles of becoming a member, principles that govern the European Central Bank, and criteria to become a member of the European Union, let's talk about how Eurozone, with its common central bank, has performed until the financial crisis of 2007. Let's look at different components, starting with inflation. So I didn't mean to do that. Okay. So inflation, when the Eurozone was launched in 1999, inflation was low, of course, because that was one of the criteria, is that inflation had to be above 1.5%, no more than 1.5%, greater than the average of the three lowest inflation countries. So all the economies were working hard to lower their inflation. So as you will see, let's see what the economies did to meet the convergence criteria. If you were to say that this is 1999, the red line in the graph below, you'll see that inflation is very noisy, but starting in, say, about 1996, about here, inflation is super noisy, but it's all converging towards a lower rate, which is close to zero, plus or minus zero, and all that is just was designed to ensure that countries can become a member of the Eurozone. Okay, so then in the year 2000, let's clean this up. Look at year 2000, the year 2000, when the dot-com bubble burst, and oil prices increased, and then we had the 9/11. It essentially began the period of great moderation. Okay, and the good part is, even within, so if you were to say this is 2001 and say dot-com bubble burst in 2000, until the financial crisis, which would be about this area, you notice that inflation has remained in check for the most part for most countries, except except Portugal and Germany that face pretty relatively negative inflation. Okay, so inflation was relatively flat for most economies. And remember, once again, we are worried about this area above zero, where prices increase. We're not too worried about areas that are manageable below zero, which would be this range identified in these two bars, the floor and the ceiling. Okay, so this was the period of great moderation. Nearly in every large country, a large number of people were convinced that, quite strangely, despite the fact that inflation was flattening or it was converging towards the zero range, people thought that adoption of euro has had caused inflation. And now there's an interesting story that goes with this. So the thought process was, let's say if you were using the German mark before the euro, and coffee would cost an equivalent to 1.95 German mark, or 1.95 euros, but in German mark. Well, the moment you convert it to euro, you as a seller of coffee was probably going to sell it for rounded up to 2 euros just for convenience. Well, those little things lead to inflation, right? But what researchers found is that yes, rounding up did happen with those little things, but the little things were such a small part of people's budget that they didn't make a significant dent in overall inflation. Big ticket items such as, say, washing machines, TVs, cars, homes, and stuff that relatively cost more money as opposed to, say, groceries and day-to-day items, they remain pretty much, their prices remain pretty much identical to what they were before all of these countries adopted the euro. Okay. And as I mentioned before, what I wanted you to also note is what's happening, say, in the last 5 years. Look at this convergence here. Look at where we were, and look at how, if you take out Greece, which is a weird case, everybody's converging close to no inflation area, which in some ways tells us that the experiment to adopt a single currency is working. Okay, so that if you want to see this graph live, I've set it up so that right now it's 2020 April, but let's say if you want to review this in May, it'll automatically update to show you, well, this is annual data, so it's not going to update until next year. But my point is it'll update every year automatically. So if you just click on it, you'll get to see the updates. Secondly, if you look at, now we talked about inflation, let's talk about growth. So until the financial crisis, growth was generally very slow in the Eurozone and it was all over the place. Some countries grew faster than the other. But the thing is, after the adoption of euro as a common currency, growth was still terrible. And this led to intense criticism. So the criticism was, oh, adoption of euro has caused a decline in growth. But if you think about it, euro was adopted in 1999, then the dot-com bubble burst, and then pretty much immediately after you had the financial, you had the 9/11 happen, and as a result, the economic shock that followed. It was brief, but it did happen. So, in other words, euro didn't really get a chance to establish itself, and people started blaming euro for lower growth. Well, this criticism is unfair because monetary neutrality principle says that by definition, monetary policy cannot necessarily have a lasting effect on economic growth. So the criticism is unfair on the European Central Bank because by definition, European Central Bank's policies only work in the short term and not in the long term. And the euro system also has argued that the growth or low growth, undesirable levels of growth, is not necessarily a result of an over restrictive stance on monetary policy, because you could see that some members of the euro system had experienced lower growth rates, but some members had experienced faster growth rates. So in this chart, we are looking at growth rates. Let's look at this. Here you adopted the euro, and in this pretty much period, many of these countries, especially you see these this pattern between, say, the light blue, the blue, and the purple lines. So it'd be those three countries. Light blue would be Denmark, Portugal, and Germany. You see their growth rates are actually coming down, and to an extent, every curve is going in the southwardly direction. So that tells you that growth has declined. But what European Union is saying, well, it can't necessarily be overly restrictive monetary policy, because if that was the case, then everybody would see significantly lower growth. And that this would not happen. Right here with this orange country, that seems to show that growth is increasing. So that would be Sweden. Yeah, so that's the European Union's argument. Okay. All right. Let's now talk about the exchange rate. So just when euro was launched in 1999, dollar was appreciating vis-a-vis all currencies. Why? Well, because to an extent you already had in place the inflation caused by dot-com bubble that was brewing in the U.S. because you hear these terrible stories about dot-com millionaires with really no with stocks that had no value or no underlying business model, and so that caused inflation in the U.S. And as a result, dollar was appreciating vis-a-vis other currencies. Anyway, this created the impression that the euro system was unable to create a strong currency because, of course, dollar is more expensive than it used to be before the creation of euro. Even though during at the time that the European politicians were trying to sell the benefits of euro to their citizenry, they basically were sharing that European adoption of euro would increase price stability, and that's not what they saw. That's not what people saw. But in 2002, the value of dollar vis-a-vis euro declined. Once again, this is the aftermath of the dot-com bubble bursting, and the 9/11. So 2002, dollar depreciated vis-a-vis euro. But here's the problem: instead of praising the euro system, now critics complained that the euro was overvalued and it was hurting exports. So clearly, there's no way for the European Central Bank or the euro system to make everybody happy. Someone is always going to be unhappy in some camp. Either way, the euro system announced and in some ways reminded that it had no responsibility for exchange rate vis-a-vis the rest of the world, in the sense that it can only fix exchange rates within the euro system, but the euro itself will be a floating currency vis-a-vis the rest of the world, especially because capital movement was free, so they wanted to make sure that they don't violate the impossible Trinity principle by then trying to fix the exchange rate as well. Okay. So the last section, the next point is one money, one policy. This point looks at various components, especially inflation as well, and other components after the adoption of euro. So since the adoption of euro, inflation has differed among member countries, and the criticism is, well, if you have the same money and if you have the same monetary policy, then inflation should not differ. But Eurosystem has pointed out that there are such differences, not only in Eurozone, but also those differences exist within the United States, which also, as everybody knows, has one money, which is the US dollar, and one policy, which is made by the central bank called the Federal Reserve. So here's a chart that I created to make this point. It looks at the consumer price index for various big cities or metropolitan statistical areas, various big cities in the U.S. So this contains charts for Chicago, San Francisco, New York, Miami, and Dallas, Fort Worth area. Okay, so as you can see, inflation is all over the place. In fact, if you see in the aftermath of the dot-com bubble burst, and here that we call the Great Moderation, in this period between the dot-com bubble and the financial crisis, inflation in various cities is all over the place. Okay. Once again, this is a live graph. If you want to see an updated graph, you feel free to click on the link. Well, the problem with that argument that the European Central Bank put forth is that the US regions appear to alternate in their respective positions, in that sometimes they have high inflation while other times they have low inflation. It's not what they're saying is it's not like certain areas are destined to have high inflation. They're saying sometimes they have high inflation, sometimes they don't. But that's not true with Eurozone. What has happened with Eurozone instead is some countries have consistently exhibited lower inflation, such as Germany, whereas other countries have consistently exhibited higher inflation, such as maybe, say, Greece. And you can see that with with the orange curve, or say, for example, Portugal also appears to have all the Mediterranean countries appear to have higher inflation. Okay. So once again, we're not discussing any theories per se. We're just discussing what has happened up to the financial crisis since the adoption of euro in 1999. Okay. So of course, we all know that a country that consistently faces higher inflation is bound to face a loss in competitiveness as its real exchange rate appreciates, right? So then the question is, well, what are the reasons as that are causing this divergence in inflation among Eurosystem members? So one very popular thought process or explanation in divergence of inflation rates among European countries is called the Balassa-Samuelson effect. And so what this effect, and this we discussed in chapter 13, but what this effect specifically states or predicts is that the real exchange rates, it predicts that the real exchange rates of countries that are catching up usually appreciate. Okay, so real exchange rates of high inflation countries will appreciate, but this appreciation is not a loss of competitiveness, but it's instead caused by rising productivity. This effect could then in turn explain high inflation in Ireland, Spain, and Portugal. So to dig a little bit more deeper, what it's saying is if you're a country that has high productivity, and you have high productivity because people are paying too much money to their in wages, and that's happening because a lot more people are employed, and there's very essentially you're throwing money to be able to find skilled workers because there are not enough, and so productivity in some ways increasing, and the only way to match the productivity gains is to hire employees and pay them higher salaries, which in turn causes inflation. So that's the Balassa-Samuelson effect. The second component could be that when they converted from their own currencies to euro in 1999, each currency was converted into euro at the ERM parity levels that prevailed in 1998. However, it is generally accepted that Germany's exchange rate was overvalued, which explains why its price levels declined by 4.5% from 1999 to 2008. But on the other hand, Greece may have used an undervalued rate for conversion, so in turn, their currency appreciated, or their real exchange rate appreciated. Okay, and as a result, there's a higher inflation. The third piece that could justify the divergence in inflation is the autonomous wage and price pressure. So what does that mean? Well, what that means is when wages increase in excess of labor productivity gains, it eats into competitiveness, right? And that makes sense, right? If it costs you more money than increased productivity from newer employees, then it's going to make you less productive and therefore less competitive. However, there are other issues that may drive wage negotiations as well. So non-economic factors, right? For example, minimum wages can be reduced to can be increased to reduce inequality, right? Similarly, civil servants, so that be the government employees who don't necessarily face any foreign competition, uh, may be better organized to extract wage gains or wage increases. And this is true in the US. If you think about the biggest unions, well, most of them are government employee unions, so be it state, local, or federal government employee unions. So government employees are in a better position to increase salaries. Okay. Second thing is because government employees are better at negotiating salaries, or even generally speaking, minimum wages, for example, are increased to reduce inequality. Prices that are thought to be preset, so utilities are thought to have preset prices because it's called a utilities like electricity producers are considered a government allowed monopoly in every country because it's extremely expensive to set up electricity infrastructure that provides electricity. So you can't have competition in that area because no two people would want to provide electricity in the same city, same state, and same area because it's just so expensive to for one to produce electricity. So what the government says is, okay, we'll make sure that you don't have competition as long as you tell us, you guarantee that certain rates for electricity. In other words, just because you're a monopolist, you're not going to charge an infinite amount. So electricity and utility providers are considered government-controlled monopolies. However, if the wages increase, generally speaking, then the cost of these utilities have to increase as well, because if they don't increase the cost, then they're going to lose money and they're going to go out of business. So they have to increase costs. Well, all of these things, including labor and the cost of utilities, tend to be inputs for most producers, right? Tend to be inputs for most producers. So in turn, it induces other producers to increase prices and wages as well, because their production costs just got raised. So it appears that research have shown that these factors have played, which is collective bargaining, appears to have played a role in high inflation rates in Greece, Italy, Netherlands, Spain, and Portugal. A fourth reason that could have caused such a divergence in inflation is policy mistakes, right? So government may have indirectly played a role in increasing inflation rates in many countries by having excessive expansionary fiscal policies or public sector price and wage increases. So you could think of wage increases, which we discussed in the previous point as well, not just as salary increases, but also as benefit increases. We all know that until the financial crisis, if I remember correctly, the retirement age in the U.S. today for you and I to get Social Security is 67 years, and I think before the financial crisis it used to be 65 years. While in Greece it used to be 55 years. So clearly, the cost to pay Social Security to these people who are not gainfully employed is borne by the government, and the government is going to pay these bills is either by printing money or borrowing money, either of which would cause inflation. Okay, so policy mistakes such as expansionary policies or excessive benefits could have caused this as well. Finally, the fifth component is asymmetric shocks, which was at the center of optimum currency area theory, may have affected certain economies asymmetrically as well, especially, for example, an oil shock could affect oil-producing nations in inflation rates asymmetrically. Okay. So we spoke about what has caused divergence in inflation. Let's talk about what has caused divergence in current account, because not only inflation can diverge, balance of payments can also diverge, which in turn would lower the real exchange rates or change the real exchange rates in an economy. Okay, so lasting divergent inflation has caused increasingly unbalanced current account deficits. For example, Germany, and this has been true forever. Germany is known to have a significant surplus, and that surplus kept widening after adoption of euro. Whereas Greece, Italy, and Spain's deficits kept deepening, so they kept having imbalance or deficit in balance of payments. And the problem is this can't necessarily continue forever. Eventually, there is going to be some sort of symmetric crisis, so crisis that affects everybody, and then it's going to hurt Greece, Italy, and Spain a lot more than it hurts other countries. So let's look at current accounts as a percentage of GDP. So if you look at Germany, the dotted line up top, they had a surplus as evidenced by the fact that their dotted line is above the zero level from 1999 pretty much to today, 2014. If you look at all the other countries, Greece, Spain, and Italy, the primarily Mediterranean countries, they all have a deficit, right? They all have a deficit. And look at Greece's deficit at the heart of financial crisis, 20% of GDP, right? So that's not impressive at all. The same with Portugal, Netherlands, Finland, and Ireland. So if you look at Netherlands and Finland, they have a surplus, but Ireland and Portugal have a deficit, which were further exacerbated in the financial crisis. Okay, so now the question is, what could have caused divergence? This is not in inflation, but in current account deficit and balance of payments. Okay, so I'm gonna have to fix that. So normally in a currency area, countries that undergo high inflation see their real exchange rate appreciate and experience a decline in exports and increase in imports. Of course, this is going to cause an imbalance in current account as well. Well, this reduces demand and increases unemployment. Of course, we discussed this as a part of Hume mechanism, which in turn predicts that this also exerts downward pressure in prices and wages, and through it, inflation. So we're talking about a correction mechanism that can be extremely painful, and this Hume's mechanism is indeed extremely painful. You start by becoming uncompetitive, right? Because you have local inflation, your prices rise too much. Now nobody wants to buy your products because your products are too expensive, and even though your exchange rate is fixed, real exchange rate appreciates, and this, as I mentioned, nobody wants to buy your products. Results in a decline in exports, increase in imports, and over time, as nobody wants to buy the products, local producers realize, look, the only way they're going to be able to sell is if they lower the prices. This in turn takes a while to filter through the rest of the economy, and inflation starts to disappear over time. But in some high inflation countries, as Greece, Spain, and Ireland, what ended up happening is demand for their products and services did not actually decrease because domestic spending remained strong, right? So what they could have done is they could have had fiscal policy or tightening that could have cooled down the economy, but they did not deploy fiscal policy. Remember, they can't have their own monetary policy because they have a common central bank, but they can have their own fiscal policy. And so their fiscal policy to deal with the uncompetitiveness from increased prices, instead of enforcing policies that would cool off the economy, they promoted increased local consumption. Maybe, for example, government started paying their employees more money. Maybe they increased social security benefits. Whatever the case may be, in these countries, demand did not go down. In Italy and Portugal, demand did go down, but wages and prices did not follow, partially because wages and prices, as we have learned before, are a little bit sticky. So once again, government in these countries could have directly impacted labor prices by enforcing labor reform, but they didn't do that. So those are the three reasons why in these five countries, Greece, Spain, Ireland, Italy, and Portugal, there were increased balance of payments deficits. With that, this is the end of chapter 16, and the last section is summary, which I won't cover because I'll let you review it.